Every single year, millions of Americans sit down at their kitchen tables, open up a laptop, and perform a ritual that they believe is keeping them safe. They gather their W-2s, their 1099s, and their receipts, and they meticulously report every cent they earned to the Internal Revenue Service. They do this because they are afraid. They are afraid of the audit, afraid of the penalties, and afraid of the crushing weight of the federal government. But here is the terrifying reality. That very act of playing it safe, of simply following the standard prompts on a tax software, is the exact moment you are being robbed. You think you're being a good citizen, but the system sees you as a source of involuntary donations. You are effectively handing over a six-figure check to the government, money that they have explicitly set aside for you to keep, simply because you don't know the secret handshake. The natural instinct is to hide, to minimize your profile, and to take the standard deduction to avoid, quote-unquote, poking the bear. That instinct is a catastrophic mistake. It is the reason the middle class stays trapped while the wealthy receive what look like quote-unquote stimulus checks for hundreds of thousands of dollars. If you don't change how you look at the tax code in the next 10 minutes, you aren't just losing money, you are funding the very system that keeps you working until you're 70. The tax code is not a book of laws. It is a 70,000-page document, and 95% of those pages are not about how the government takes your money. They are about how the government wants you to spend it. Think of the IRS not as a debt collector, but as a massive, clumsy venture capital firm. They have specific goals. They want affordable housing, they want energy independence, and they want technological innovation. Because the government is inefficient at doing these things itself, it offers you a quote-unquote bribe to do it for them. This is the quote-unquote insider secret that the billion-dollar tax prep industry doesn't want you to fully grasp. They want you to stay in the quote-unquote compliance lane where you pay a fee to be told how much you owe. But the wealthy live in the quote-unquote incentive lane. The mechanism that causes most people to fail is called tax erosion. It's the silent killer of wealth. When you earn $1, you're taxed. When you spend what's left, you're taxed. When you invest the remainder and it grows, you're taxed again. Most people try to fight this by saving more, but you cannot outsave a system designed to erode your capital at every turn. Ignorance of these specific incentive structures is not a defense. It is a choice to remain a donor rather than a partner. The IRS is literally authorized to pay you via credits and massive deductions, sometimes exceeding $100,000 in a single filing year, if you simply pivot your investments into the 4 specific sectors they are currently obsessed with. If you don't, you are essentially leaving a winning lottery ticket on the sidewalk because you're afraid of the fine print. Scenario 1, the solar trap and the $30,000 credit. The situation: you are a homeowner or a business owner looking to lower your overhead. You decide to go green by installing a massive solar array on your property or your commercial building. The cost is $100,000. You've heard there are tax breaks, so you sign the contract, get the panels installed, and wait until April to tell your accountant. The mistake: most people treat this as a simple expense. They wait until the end of the year and try to claim a basic deduction, or worse, they let the solar company handle the paperwork. The mistake here is failing to understand the difference between a tax deduction and a tax credit, and failing to document the basis. If you don't structure the financing correctly, you might find that you don't have enough tax liability to even use the credit, meaning the IRS keeps the money while you're stuck with the loan. People often take a personal credit, Section 25D, when they should have structured it as a business investment credit, Section 48, which allows for accelerated depreciation on top of the credit. By taking the intuitive path, you lose out on nearly $40,000 in immediate liquidity. The solution: you must trigger the investment tax credit, ITC, with precision. Before you sign any solar contract, you need to use this specific script with your CPA or tax strategist. I am planning a Section 48 investment tax credit project. I need to verify my tax liability for the current year to ensure I can absorb the full 30% credit. Furthermore, I want to evaluate if we can use bonus depreciation to write off the remaining 85% of the adjusted basis in year one. To execute this, do not just keep a receipt. You need a project completion certificate and a detailed cost segregation breakdown from the installer. If you are a business owner, you can often get the IRS to effectively pay for 50% to 60% of the entire system in year one through the combination of the 30% credit and the massive depreciation deduction. This is a direct injection of cash back into your pocket that most people leave on the table because they didn't label the investment correctly in the eyes of the IRS. Scenario 2, the opportunity zone wipeout. The situation. You've been a disciplined investor. You bought some stock or a piece of property years ago, and it has exploded in value. You're sitting on a $200,000 gain. You want to sell it to diversify your portfolio or buy a new home. You sell the asset, realize the gain, and prepare to pay the 20% capital gains tax plus the 3.8% net investment income tax. The mistake. The intuitive move is to just pay the man and reinvest what's left. This is a catastrophic waste of momentum. By paying that $47,000 in taxes today, you are losing the compounding power of that money over the next decade. Most people don't realize that the IRS has designated over 8,700 qualified opportunity zones across America. These are areas the government desperately wants to see revitalized. The solution. Instead of sending that $47,000 check to the IRS, you have exactly 180 days from the date of your sale to move that gain into a Qualified Opportunity Fund, QOF. Here is the script for your financial advisor. I have a realized capital gain of $200,000. I want to defer the taxes on this gain by investing in a qualified opportunity zone. I need you to identify a QOF that meets the 90% asset test so I can eliminate my capital gains tax on any future appreciation of this new investment if I hold it for 10 years. The insider secret here is that if you hold that OZ investment for 10 years, your tax bill on the new profit is zero. Let me repeat, zero. You could turn that $200,000 into $1 million and the IRS won't take a single cent of the gain. You are using the government's own money, the taxes you deferred, to build your own wealth. Scenario 3, the R&D credit for the average business. The situation. You run a small manufacturing shop, a software startup, or even a specialized craft business. You spend money every day trying to improve your products, testing new materials, or developing more efficient ways to ship your goods. You view these as operating expenses. The mistake. You assume that research and development is only for companies like Apple or Pfizer. You think you need a lab coat to qualify. Because of this, you simply deduct your expenses on Schedule C or Form 1120. This is the safe mistake. You're getting a deduction, but you're missing the Section 41 credit, a dollar-for-dollar reduction in your tax bill. The solution. You need to apply the 4-part test to your business activities. The test asks, is the activity for a permitted purpose? Does it eliminate uncertainty? Is it a process of experimentation? Is it technological in nature? If you are trying to make a faster widget or a better app, you qualify. Use this script with your payroll provider or accountant. I want to conduct an R&D tax credit study for the last 3 fiscal years. We have been performing experimental development as defined under Section 41. I need to calculate our qualified research expenses, including wages, supplies, and contract research. The IRS will often issue a refund check for taxes you paid in previous years once you claim this credit. For a small business with a few employees, this can easily exceed $100,000. You aren't taking money, you are being reimbursed for the risk you took to innovate in the American economy. Scenario 4, the Defined Benefit Super Shield. The situation. You are a high-earning consultant, freelancer, or small business owner. You're making $250,000 a year, and you're frustrated that you can only put about $6,500 into an IRA or $23,000 into a 401k. You feel like the tax code is capped against your success. The mistake. You follow the standard advice. Max out your 401k and just deal with the high tax bracket for the rest of your income. This results in you losing nearly 40% of your top-line earnings to federal and state taxes. You are playing a game with a ceiling, while the IRS has actually left a massive hidden door open for you. You need to move from a defined contribution mindset to a defined benefit mindset. A defined benefit plan, or a cash balance plan, allows you to contribute and deduct staggering amounts of money, sometimes up to $200,000 or $300,000 per year, depending on your age. The IRS pays you by allowing you to keep that money in a tax-sheltered environment instead of taking it as income. The script for your pension actuary is, I want to establish a solo defined benefit plan combined with a 401k profit-sharing component. I want to maximize my Section 404 deduction limits to reduce my taxable income to the lowest possible bracket while front-loading my retirement savings. This is how a person making $400,000 a year pays less in taxes than a teacher making $60,000. It is perfectly legal, highly encouraged by the IRS to ensure people are self-funded in retirement, and almost entirely ignored by the general public. The 5-minute shield. To protect yourself from the tax erosion and ensure you are positioned to receive these 6-figure incentives, you need to execute one simple task today. It takes less than 5 minutes, but it creates a legal shield around your finances. You are going to create a substantial authority folder. The IRS cannot penalize you for taking aggressive tax positions if you can prove you had substantial authority, meaning you relied on specific sections of the tax code or professional advice at the time of your filing. 1. Open a digital folder, Google Drive, Dropbox, or a secure hard drive, labeled IRS Incentive Shield Year. 2. Inside, create a document called Basis Log. 3. Immediately upload 2 things: your most recent tax return and a letter of engagement from a CPA or tax attorney that specifically mentions tax planning and not just tax preparation. 4. The 5-minute action. Send an email to your current tax preparer with this exact text: I am moving my focus from tax compliance to tax strategy. For our next meeting, I want to review my eligibility for Section 48 credits, Section 41 R&D credits, and the feasibility of a defined benefit plan. Please confirm you have experience in these areas or recommend a specialist. By sending this email and starting this folder, you have officially moved out of the donor category. You are now a strategic partner. If you are ever audited, this folder proves that your intent was to follow the government's incentives, not to evade your responsibilities. This simple paper trail is the ultimate defense against the clumsy power of the IRS. Protect your circle. What you've learned in the last few minutes is information that people pay tens of thousands of dollars to receive from high-end wealth management firms. Most people will go their entire lives without ever hearing the words Section 48 or Opportunity Fund. They will simply keep working, keep paying their 30 to 40%, and wonder why they can never seem to get ahead. Do not just keep this information for yourself. Look at your friends, your family, and especially the small business owners in your life. They are likely struggling with the weight of inflation and taxes, completely unaware that the IRS is holding a reimbursement check for them. Sending this video to them isn't just a recommendation, it's a vital service. It could be the difference between them closing their shop or expanding it. It could be the difference between your parents retiring comfortably or working through their 70s. I want to hear from you. Have you ever tried to claim one of these Big Four incentives only to be told by a lazy accountant that it was too complicated? Or have you successfully used one of these secrets to change your financial life? Share your experience in the comments below. Your story might be the final push someone else needs to finally stop being a, quote, voluntary donor and start building their legacy. Remember, the system is designed to reward those who understand it and punish those who don't. Which one will you be?